This is Trepp Wire Week in Review for week ending April 2nd. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, with the vaccination rollout accelerating, more firms are announcing their return to work schedules. And President Biden unveiled a $2 trillion infrastructure plan. And while economic data shows choppy progress, consumer confidence is the highest since the pandemic. U.S. manufacturing activity soared to its highest level in more than 37 years last month. Initial jobless claims climbed last week, and pending home sales plunged last month after record low inventories. And of course, tomorrow's March jobs report is anticipated. Many are expecting strong progress. And finally, the blow up of Archegos may spur regulation. So a lot happened this week.
It was an interesting week, to be sure. Let's start with the jobs report. We came out with a very, very good ADP report, although it was below expectations. I think we had about 520,000 jobs added by ADP, which was triple the number of jobs, private jobs that were added in February. Yet that number was slightly below the 550,000 that market watchers were expecting. And now we have the jobs report tomorrow, which expectations are really all over the place. I think Barron's is saying consensus estimates are about 550,000, Bloomberg 650. Zero Hedge said some people are talking about something north of 1.5 million, right? Something just extraordinary as we get back to work. So whatever that number is, it's going to probably disappoint some people, right? If we don't get to something close to 1 million tomorrow, those people that were on the upper end will probably be disappointed. So that could be market moving. It's very interesting because it comes on a day when the stock market is closed and the bond market has half a day. So stock traders will have 3 days to kind of digest this, and whatever rockiness or enthusiasm comes out of the number will not be really seen until Monday. Separately, the Archegos story, also quite interesting. For those that really didn't follow it, Archegos, which was basically like a family hedge fund, had taken enormous positions in a couple of entities, Viacom being one, Discovery being another. They had so much exposure that when stocks started to fall, they had to go through a forced liquidation. And that forced liquidation was so painful that Viacom and Discovery dropped, 30% in one day. And because it was so disorderly, that sell-off, it left some of the creditors to Archegos with big losses. So Credit Suisse and Nomura already said that they were going to have substantial losses due to this untidy unraveling. I think JP Morgan came out and said that they think total losses could total $10 billion for the various banks. And this is of a piece, like we said, with GameStop, which is when GameStop started having that run up, when there was the short squeeze, what we said is sometimes things like this can really undercut other firms and lead to contagion. And when contagion takes place, that's when you could see meaningful spread widening. And that was the concern early this week with Archegos, that, what's the other shoe to drop? Who's the creditor we don't know about? By week's end, that seemed to have been dismissed, right? That there won't be contagion. But it is just a reminder that sometimes these exogenous events can really move the market in ways that nobody ever sees coming.
When are we going to learn? Right. I mean, there is an element here, and I don't know all the details. All I know is what I've been reading in the articles and stuff, but it wasn't like this family office owned the shares. They were in some sort of swap agreements where they were basically betting on the movement of the shares upwards. I think Discovery was one of them and a couple of others, but those shares dropped 20, 30, 40%, but they're still up massively if you look year over year or the last year and a half. But just imagine being that prime brokerage guy who has Archegos as a client and says, yeah, all right, fine. We got $1.5 billion in exposure to Discovery shares, let's say. You got to think there's a failing in risk management there at some point, right? And maybe the hedging was correct when they first entered the trade, And then as the value of the stocks increased and increased and increased, they didn't have an increase along with it in how much they were hedging. When you're buying and selling stocks, like you can't really get in too much trouble. But when you're adding on leverage and adding on derivatives and adding on swaps where, you can kind of 10x your notional, bet there, then that's when you get into some real funky areas.
To take this back to CRE to some degree, and I have to underscore what you said, Joe, which is that I'm not an expert in these kinds of strategies.
They're CDFs, just like CDS, maybe?
Well, in a way, the big problem with whether it was the betting of ABX or the betting on CMBX before the great financial crisis is that there wasn't a lot of transparency, right? You could take a $100 million position on the other side of AIG, but you would never know how many other $100 million positions AIG might have had with your competitors, right? And so when the house of cards started to fall and the exposure to these credit default swaps in aggregate started to come out and started to impact some of these guys that had been long, right? Only then did we realize what a problem it was. And this may be the same case here. Again, I don't know this market well enough to know how transparency works, but it could be something like that where you just don't know how many other guys are on your side of the bet and how crowded it will be trying to get through that revolving door all at once if there is a problem.
We're releasing our latest CMBS delinquency report, and we see signs of improvement. Manus, walk us through what the data says.
It's been a real nice run for CMBS. This is our 9th straight month of declines. For those that have been listening a long time, this will not come as a big surprise to you. We saw the worst of it in May and June. In June 2020, we saw the highest delinquency level since the great financial crisis was unwinding. We had peaked in the great financial crisis at 10.34%. We got within 2 basis points of that in June, and now we've seen 9 straight months of decline. This month, another 22 basis points in decline. So we've now gone from 10.32% in June of 2020 to 6.58% overall across all property types as of March 2021. Even the hardest hit areas have seen some nice improvements. Lodging last month dropped about 40 basis points in its delinquency rate. To be sure, it's still troubling at almost 16%, but it is down from 24% in June of 2020. In the retail side, there too, a big decline, about a 1% decline from February to March. It's now under 11% after having peaked at over 18% last summer. So all these are great positive trends. Some other things that we're seeing this month, we saw a dip in the special servicing rate by about 20 basis points as well. That's been a little bit slower to come down. The number of loans in special servicing tend to be a lagging indicator because even after a loan cures, it usually stays in special servicing for 3 more months as the special servicer monitors the situation. But we did see improvement there. A metric that we watch quite a bit is the percentage of loans that are in grace period, meaning they're not yet 30 days delinquent, but they use their grace period in March, missed the March 1st payment, but not yet 30 days late. That reading came to under 2%. It's the first time that's been under 2% since May 2019. So fewer and fewer borrowers using that grace period. The only quote unquote negative, if you will, and it's not really a negative, it's the percentage of loans on a watch list. It moved up by about 1.5 points from 23.3% to 24.8%, but that should be taken with a grain of salt. It's probably not loans going on watch list from being not on anything. There's a good chance that these were loans that were with special servicer and now have been returned to the master, but they remain on watch list for one problem or another.
When we were going from, 3.5% delinquency all the way up to 10, 11-ish percent, that was crazy wild. We wanted to be on top of that. Now that the number is not moving as much, I think what we should put in there is kind of velocity or some sort of indication of how many moved out And of the ones that moved out, why did they move out? Right? Because if the delinquency rate is going down because we're disposing a bunch of loans with losses, that's a little less of a positive than if the delinquency rate's going down because we're moving a lot of loans back to current, they're curing or they're paying off, right? So we do have the payoff report, we do have losses, but kind of putting that all into one picture, I just gave myself a project for next month, I think.
I don't think you need to, because our very own Catherine Liu has done most of this work. I'll tease this up for something coming out next week, which is we did a study of.
That wasn't even on purpose, that segue, by the way.
Not on purpose, no.
This is new to me. Whatever you're about to say is brand new.
You know, we've used the analogy of the bathtub where there's water draining out of the bottom at the same time water is coming into the top. So the level of the bath water may never change, but there's a lot of things happening.
My 2-year-old son understands that analogy very well.
There you go. And what we're seeing is that 10% special servicing number, which has been fairly static. It hasn't moved a lot. It's come down, but very marginally month over month, is really made up of something which is more like a 14 or 15% total number, that some have come in and gone out, some continue to come in.
Yeah.
And so for those that think it's the same loans that are in that 10%, that would be a misconception. There's a lot of circulation in that bathwater, so to speak. And good thing. Good thing for that too, right? That makes this up. But we have a piece coming out next week, which will discuss that a little bit. So, Joe, you teed me up without even meaning to.
It's the mysterious alchemy.
So focusing on office, we've talked about office over the last several weeks due to the rise in supply in this sector as companies are rethinking and shrinking their office space. But in the last week, with vaccines rolling out, more companies are actually making different announcements about their return.
Let's first take on the big dog, which is Google. They were the first really to take a big leap in sending people home, and also announcing, before anyone else was announcing, like when people still thought we were going to be back in the office in a month or two, that's when Google said, we'll be back next year. That was back in 2020. And I think a lot of people followed their lead. Now, according to Jennifer Elias at CNBC and a bunch of other places, I'm sure, Google is accelerating their reopening plans. And I think the biggest part of this is that they are only going to allow people to work from home or work remotely for 2 weeks out of the whole year. And if you want to work remotely for more than that, you're going to have to get approval. So they're really seemingly committing to, fully back in the office. And for a company that is eating the world, one of the 4 or 5 tech companies that is eating the world, at least they're not eating commercial real estate at this point. So that's good to see. I hope that, this is kind of one of the companies that led the way on the way out of the office. So hopefully they're leading the way back into the office here, which would be huge.
My daughter used to work as a summer intern at Google in Manhattan, and they had one of those offices where they had the spiral slide going from one floor to another. And I was just thinking, on the spiral slide, are they going to have, like, if somebody goes down it, they're going to have another guy swabbed in hand sanitizer to ride down afterwards, right? To make sure that the next person going down won't pick up any germs. I don't know how that's going to work, but I think it's great. I think Google going back is terrific. It'll be interesting to see how much blowback they get. I mean, people have fallen in love with having their Mondays and Fridays, at home in addition to every other day, but I think they're going to continue to want that. You may see pushback about only 2 weeks out of the year that you can do this. I think that there's going to be a lot of debate over how many people come back, how often they come back. And I don't think Google has heard the last word from their employees yet about how this actually plays out in real life. We'll see.
I also saw a headline from The Real Deal either today or yesterday, which said, it's another one of these surveys, so who knows how accurate any of it is, but it was something like 20% of companies expect to downsize their office space. And the thing about any of these predictions is that even if 5% of companies downsize, and if let's say they downsize by 25%, like that's a huge swath of space, right? And a huge kind of turnover, disintermediation, whatever, however you want to call it. And so, valuations of office buildings everybody's Argus models have to be rewritten, I think, at this point.
It's interesting as, Google has this edict that people are coming back. I've predicted that some people are going to push back. I don't know if it'll be Goldman-esque where, people write letters and talk about the inhumane conditions, but I do think that there'll be some blowback. But on that point, I don't know if you guys saw this week, that in response to being pushed so hard and being forced to work on Saturdays and Sundays, Goldman or some Goldman managers were sending their overworked employees fruit baskets as, little tokens of appreciation. I don't know if I'm getting one of those things that has, an aluminum foil wrapped pear. I think that's worse.
That only say
That's
you work
worse than
100
nothing
hours
at
a week.
all. That's worse than nothing at all. Right.
It's like when people send stuff to our house. We have a new house and they send you like stuff that's not really useful. And you're like, you just gave me a chore. Like,
That's
I
right.
need to open this box. I need to take this stuff out. I need to throw it in the trash. I need to bring this box outside. And back to breaking down boxes. That's a common theme on this. But anyway, did you see some of the other banks though? I think Goldman were the martyrs. They got fruit baskets, but some of the other bankers are getting Pelotons. They're getting days off. They're getting no Zoom Fridays. I mean, I don't know. I think whoever makes it through the torture chamber of Goldman investment banking to the other side is going to be pretty tough and well set up for the future, I guess.
If I'm a Goldman banker, junior banker, and I've gotten one of these pears wrapped in tinfoil, I am unwrapping that thing and I'm putting it in the guy's, wingtips in his office closet, knowing he won't be there for 6 months. And let's see how that
It's like
that
taping
ages.
it's like taping the open can of tuna under the guy's desk chair.
Oh yeah, that was always a great prank. So for you guys, some guys are getting Pelotons, right, at other banks that, some of these guys working really hard at getting a $2,500 at-home bike. And I've already told you what I think about the pair, and I do like a Peloton, but if somebody's going to spend $2,500 on me, I think I want a 10-game plan to the Rangers, like a 10-game package.
Yeah, but then
Pretty
you
good
can't.
seats.
You can do work on the Peloton. That's the thing. You can't
What
do
would you
work at
take,
the Rangers
Martha? What's
game.
your what would be your gift of choice for $2,500?
It's always the same. I'll take the cash, please.
Cash, please.
Well, I'll say one more thing. And there's a total element of work from home issues here, because if you're working crazy hours, but you're in the office with 30 other analysts your age and you're all working like crazy and you can all turn to each other and say, can you believe this? This is nuts. They can go out for a beer at 2 a.m. or whatever. That's a lot better than literally being alone in a cramped apartment in Manhattan, working like crazy on the next SPAC.
Yeah, I guess so. There's always people around you to offer you fresh fruit if you're looking a little peaked.
I once worked those type of hours alone for a little over a month. I could not hack it. I'll tell you that. I would not be able to do it.
I remember those days.
Do you remember that? Yeah.
I
Someday,
do.
if you guys want to hear the full story, it'll have to be off the
I
record.
remember those days. Well, the story hasn't finished playing out. And Manis brings up a good prediction. Even though Google is preparing to go back, they're only going to go 3 days a week. Uber only has 20% of their employees working from the office, and Facebook 10% will be back in the office. So even though they're talking about going back, they're not going back at 100% the way they had been.
Yeah. On the other side of the coin, we did see a story this week that Caremark, a big tenant in the Baltimore area, is allowing, they're a healthcare firm, allowing 55% of their workers to work remotely. So more than half. They are a huge, they have 700,000 square feet or more in the Baltimore area. One office has almost 500,000 square feet. Its lease is due in late 2021. They have another one, 270,000 square feet, which is up in June. People that read our research probably already know this. The Bico 1 tower is in that market, 40% occupied by Caremark. It's one of those leases that ends in June 2021. It backs a $10 million CMBS loan. And, so the counterweight to Google and others, Morgan Stanley and so forth going back, here you have Caremark saying that more than half of their employees are going to be working from home going forward. On the same note, one thing that really concerns us, a market that concerns us, is Baltimore in general. In addition to Caremark giving up all this space, we had that story a couple months ago about 100 East Pratt Street. That's a 660,000 square foot building. 71% of that goes to T. Rowe Price, and they've already signaled that they're moving on. So there you have another huge swath of space that is going to be open. T. Rowe Price has a lease that goes until 2027, but they can terminate in 2024 with a $20 million payment. So if you're looking for soft areas right now, I think Baltimore is on the short list.
Well, just a quick digression here, and maybe some of you out there can identify with this, but there are two reasons that I know that it's time for me to go back to the office, and they're both to do with my office arrangement. First is that every time I sit down on my office chair, about 30 seconds later, I'm a foot lower. I have an imperceptible movement issue on my office chair. I don't know if that's strain and fatigue on the chair itself, or if I've reached the maximum load capacity of this chair. It's probably a little bit of both. On a related note, the thing you put under your desk chair on the carpet, like the plastic thing so you can roll around, it's got several cracks in it. So now I don't roll, I actually just fall into the cracks, into the space. It's like that spot on the couch that's like perfectly conformed to your body. So I think I need to go back to the office, if only to give this chair a rest.
You sure it's not spinal cord, compression? Too much time in the chair?
Definitely could be. I could have lost, I could be like 2 or 3 inches shorter after COVID.
Your disc fluid may be dissipating.
You're going to be our height. Turning to multifamily, we've talked about this many times on this podcast. Falling occupancy is a concern, and it continues to be a problem. And we're looking at the data in some detail. What are we finding so far?
Well, we're early in our analysis. What we're trying to do is get a sense of where are the pockets of weakness in occupancy across the U.S., looking at both private label CMBS and Freddie Mac data. We've had a thesis about this based on our own anecdotal looks at certain big loans that major 24-hour cities were going to see real big numbers compared to the rest of the country. And while our analysis isn't complete, we're going to try to get this out next week. It is definitely the case that the big 24-hour cities are running at multiples higher than the rest of the country when it comes to occupancy fall off. Perhaps that makes perfect sense. These are areas that have mass transit, so people really, didn't want to be in an area that was close together. Their apartments are expensive, right? So if you're living in a place where there is no ecosystem to enjoy yourself, no bars, no concerts, no games, why spend the money? And, most of these places are in areas that were fairly hard hit by COVID, New York being the biggest one. So it just underscores for me, as I'm looking at this data, that if you're a property owner, if you're an apartment property owner, if you're a municipal leader, a mayor or a councilman or something like that, your data in one area of the country may be vastly different than in other parts of the country. We're seeing tons of smaller MSAs where the percentage of loans that saw meaningful drop off in occupancy is negligible. And by meaningful, we were looking for loans whose occupancy had gotten to below 80% at the underlying collateral. So nationwide, it's a small number. In many smaller rural areas or smaller cities, it's almost imperceptible. And then in places like Long Island City, New York, Chicago, San Francisco, the numbers are big. And I think that if you're a property owner, it's interesting data to look at. And it's certainly something that I would think if I'm a property owner, I want to know, how am I doing relative to my peers in this particular time frame?
Is it gauche? Is that the right word? Is it gauche to say that when you completely lock down a city, people leave? Right?
Not if it's a
Like,
fact.
I mean, that's what we're seeing, right? The states and cities that had a different approach performed a lot better economically, and nobody wants to pay $3,000 a month to live in a studio when you can't leave your apartment. So that's, it's interesting data, and it's confirming what we would have expected.
It's there was a piece out this week by Fannie Mae, which underscored the fact for me that it's not just young people leaving. Certainly young people left, and it makes sense because for those that don't know the New York market or Washington, D.C., or, other, Boston, these are expensive places to live. And you're nut, I would say, if you're a young person, between just the rent, commuting costs, if you're taking the subway, if you have a car, forget about it. If you're under 25, your insurances and parking is just extraordinary. You probably have to make $75,000 a year to break even, to cover that nut. And if you're not getting anything out of the city, you leave. But the thing about the Fannie Mae study is that what they found in some of these same places that I'm talking about, New York and San Francisco, is that people of home ownership age, so this would be more people 28 to 40, really fled those cities in huge numbers to move out of either their condo or their rental in these cities to something much more suburban or rural, leaving the city for good. So something to watch, and look for this research from us over the next week or two.
Turning to retail, we've talked about New York quite a bit, and a number of stories about Fifth Avenue, Manhattan are highlighting persistent vacancies and troubles.
Yeah, there's actually a story. There was a couple stories that are worth bringing up. One was from Bloomberg, talking about a 20-block stretch of Fifth Avenue. We've talked about some of these buildings in the past specifically, and some of their tenants who are either refusing to pay or struggling to pay their rents. And based on their kind of survey of this area, there's about $200 million in back rent owed to landlords across this stretch. And I think one of the interesting lines is that these were places that were starting to struggle even before the pandemic hit, due to the incredibly high rents they were paying and, just classic brick and mortar struggles. But these types of things roll up into the borrower or the owner, and then into the ultimate lender. So, this whole concept of, I'm going to have a flagship store on Fifth Avenue in Midtown, even it's going to be a loss leader for me, but it's going to lead, it's great for my brand and it's great for my online sales and everything else. Like, I don't know if that's going to continue.
It's an issue. I think that if you don't have, 100,000 people walking past this thing every day or every couple of days, what's the value of it? The interesting thing about some of these properties is, the retail space may only represent 5% of the entire office, but sometimes it could be 20% of the revenue in, behind a loan.
I think there was one we talked about months ago where it was like 60% of the revenue.
There's one in Times Square where the retail parcel is, I think, 20,000 square feet, but there's like 14 billboards above it. And part of the rent is to cover those billboards. And all it does is advertise that retailer's products all across Times Square. And that is, you have to think that if New York is very slow to come back, that's a lease that's not going to get renewed. Or if it does get renewed, it's going to be at a fraction of the price that people were getting in the past. I forget which one it was, but I do agree that whole stretch of Midtown, it was a problem before COVID began. It's a problem now. And it's not just limited to the Bloomberg article. It really stretches up Madison Avenue, up to the Upper East Side, when you have jewelry stores and fur coat stores and high-end fashion and so forth. I think all of those parcels have become tremendously under pressure. Turning to something that is the 180-degree opposite of that, There was a story in Real Estate Weekly online, and even though it seems like 85% of the retail market in Manhattan is messy or ugly, you have this situation on the corner of Central Park. So it's at Central Park South and Fifth Avenue. For those that saw the movie Big, it's where FAO Schwartz was. It's where Tom Hanks played on the piano. He did Chopsticks with Robert Loggia, I think was the other actor. It was a great scene. It was a great movie for that matter. But that retail parcel is on the ground floor and is underneath 767 Fifth Avenue, which is also known as the GM building. A couple of years ago, Under Armour took 53,000 square feet at that for $30 million. And that was in 2016. So you can just imagine 53,000 square feet for $30 million a year. They decided that they're only going to use half of it, and they're looking to lease 24,000 square feet of that space for $20 million. So almost $1 million for every 1,000 square feet of space is what they're looking for. So this is the polar opposite of the problems. They're thinking that somebody like, I don't know, Cartier or Gucci or somebody may come in there and say, we want something which is really right at the heart of, Manhattan. Right next to it, this was the site of the first Apple store, which is really cutting edge, half upstairs, half downstairs. And that has attracted millions of people a year. So maybe they know what they're doing.
Turning to hotels, we had two stories of hotels that were interesting because they've been hurt by both the lack of travel and live sports fans.
Before we get to those, I'll put a couple of other headlines in there that I thought were kind of interesting this week. Globe Street put out a piece which said the debt markets are becoming more competitive for hotels. They're starting to lend on hotels, and even at leverage levels that are not the kind that we expected to see maybe 6 months ago, right? Where somebody would only maybe lend on a 30 LTV or a 35 or 40. And, it's a sign that lenders are getting comfortable with this idea that once the opening comes back, it will be powerful, and they're not taking that much risk by lending on hotels, maybe 90 to 180 days ahead of this, real powerful recovery. The other was that, we were a little skeptical, not skeptical, we were interested in this Blackstone Starwood purchase of extended stay. We said that that's a bet on part of the market that we thought would be the slowest to come back. There were a couple of articles this week that revealed that the people who own extended stay stock, which Blackstone and Starwood are trying to take private, feel like they're getting the raw deal. They want those two firms to up their bid. In fact, the stock price lately has been trading above the latest bid from Blackstone and Starwood. So I guess they're not the only ones who think that extended stay hotels will rebound in earnest over the next year.
So the other story, which I think there was an S&P note about this, there's the Hilton Baltimore, which is, I